Hello, vetted VA community. Welcome to another week of our mortgage market update. I, of course, am Helmer, just some guy who knows a few things. But the real brains behind us today on April 5th is Brandi Brickler. Brandi, thank you for joining us. You're our guest today. Please take a minute and tell everybody a little bit about yourself.
Thanks so much. I am been in the mortgage industry for about 10 years now. I have been assisting or helping out in the vetted VA community for about 2 years now. And yeah, I'm excited to hear what you have to say.
Well, I see that you like ticks and high, or maybe you do loans in Texas and Hawaii. Is that what that means?
Correct. Yeah, I'm licensed in both Texas and Hawaii.
Now, for consumers, and that's one of the things I have to remind originators about all the time, most consumers don't realize that we actually have state-by-state licensing. They think if they're going to get a mortgage, that anybody can help them get a mortgage. You know, it's not like you go to the bank and the bank teller needs to be licensed, but originators do need to be licensed in each of the states to prove that they know the laws and aren't going to commit fraud and hurt people. So Brandi is a professional in Texas and Hawaii for those of you that are out in those areas. So well, welcome everybody. Thank you for joining us. Remember, if you do have any questions, please post them in the comment sections. Let us know that you're here. If you are here live, say hello. Let me know which community you're in, whether you're a mortgage professional, whether you're a consumer. Remember, we talk about rates and all the market stuff on this show, but we can answer any questions that you guys have. Brandi is a vetted VA expert, and she'll know the answers much better than I will. So we'll let her handle all the tough questions. If you're watching on the replay, do us a favor, give us a hashtag replay in the comments. I know many of you don't make it live, but you do watch the replays. If you are thinking of buying a home, give us a comment. Let us know that you're out there looking. Let me know that the show helps you. We always appreciate hearing that. So jumping right in, Brandi, I'm going to go to our slides. I'm going to fast forward a little bit here and kind of let's go over and let's talk about rates. Remember, this is not an offer to lend. When we talk about rates, we're talking about averages and generalities. And of course, you always want to be shopping around with your rate. And so just to recap on what I said last week, I said that rates would stabilize because we had seen them bouncing up a bit and then down a bit. And then we had the bank crisis. And I said things are going to kind of settle in. I said it was unlikely that they would go much higher, while markets believed that the Fed was going to pause their rate hikes. And I said that it was unlikely we would go too much lower without another crisis, without something happening where we had another bank failure or something like that. So what did happen? What really did happen? So basically, if we did a recap of last week and what happened, rates did remain stable. Very, they kind of went up and down within an eighth of a point range generally as an average. And but they started improving yesterday. Yesterday was a big day. I'm going to talk more about that in a minute. VA rates, for those of you that are trying to get an idea, they were generally in the low sixes for the last week or so, but they are falling again into the high fives. At least that's what I'm seeing, and we're going to get Brandi's opinion in a minute. And conventional rates were in the mid sixes. If you're getting a conventional loan, you're not using a VA benefit for any reason, you'd find loan rates that start out in the mid sixes. They are poised that they could move lower though. So Brandi, what did you see over the last week? What did rates kind of do in your world?
They haven't really changed. Like if there was a reprice or like we were seeing that rates were getting better, I didn't see as many of those, but I didn't notice any reprices better, but rates did seem better today.
Yeah. Rates have improved a little bit today. So that's kind of as far that almost goes into our forecast section. So we'll pull that up real quick. So basically, yesterday was a big day. And what had happened is that we had seen markets starting to kind of come to terms with the fact that this banking drama was not really a crisis. Excuse me. And that the Fed was likely to raise rates at the next meeting in May and possibly keep rates higher through 2023. Now, we've talked about this before, and I'll show you guys a quick little chart. These are Fed futures, and this is what we look at to kind of get an idea of what we think the Fed is going to do. This is how we gauge what the Fed's activities are going to be. So right now we're looking at the next meeting, which is on May 3rd. It's about a month from today. Right now, markets believe that rates, which are currently, the Fed funds rate is currently at 4.75. There's about a 60% probability that it's going to stay that way, that they think the Fed is done hiking rates because because the economy is starting to show signs of slowing down. We had the banking drama. So a lot of the markets are pricing in the fact that they think the Fed's going to have to pause and not raise rates at this meeting. Now, there's still about a 40% probability that we'll see some rate hikes. Now, this is this morning, and these are current trading. Go ahead.
This was quite a bit different than a couple days ago, right? I mean, yesterday
Yes.
It's kind of all over the place.
Yes, and you are so right. Yesterday, it was actually reverse, where we had a 60% probability of a rate hike. And that's where we've been over the last couple of days. That's why rates have kind of stabilized. But yesterday, mortgage rates started to improve. And as a quick reminder for those of you that may not watch on a regular basis, right now, mortgage rates are basically chasing the Fed. And when the market thinks the Fed is going to raise the Fed rate, then mortgage rates react now and they go higher, because they think the Fed is going to be raising rates in the future. Mortgage rates react now. If we think that the Fed is going to pause rate hikes, possibly even lower that Fed funds rate sometime this year, mortgage rates will actually improve on that news. And it's kind of dynamic. So, as expectations are, if Brandi and I are talking and I say, Brandi, I think things are going to get worse, then mortgage rates are like, oh no, they're going to get worse. And they immediately react. And if I say, Brandi, I think things are going to get better, then everything, all of a sudden, mortgage rates get better. So the forecast for where we're going over the next week or so, that has a lot to do with what we saw as far as seeing this expectation. So right now, markets believing that we're going to see the Fed have to pause. And as we work our way through the year, sorry, I know that little piece keeps coming down, but as we work our way through the year, the Fed is starting to look at, the markets are starting to look and say, hey, the Fed, not only can they not raise rates, they're going to have to lower rates. And the Fed members, go ahead.
Mm-hmm. I was going to say, this is just what I'm telling my realtors. So when I speak to my realtors or my clients, it's sort of like the market is not believing that the Fed can actually raise rates higher without choking out banks. So, the market is kind of determining where it's going to go based on, what the expectation is. So something has to break.
And I'm going to pull up, here was some comments that were made from one of the Fed members. She is the Federal Reserve Bank Cleveland president, Bank of Cleveland president, Loretta Mester. And, a lot of the Fed members are saying the same thing. They're saying, hey, we think that this benchmark rate needs to move above 5% this year, and that it needs to stay that way for quite some time. In fact, they actually take a survey of that at the last Fed meeting, and this is called the Fed dot plot. And what these dots mean is, you can see this line for 5%. All the Fed members believe that the rate is going to be 5%, 5.25%, 5.5%, maybe even 5.75%. So the Fed members believe that they're going to have to keep that rate higher as we go into the end of 2023. But markets are totally dismissing that. They think that the Fed is going to have to cut rates, and that by the time that we get to December, where Fed members say, hey, we think rates are going to be at 5.25% or 5.5%, again, for that policy rate, the markets are saying that they think that rate might be 3.75 or 4%. So as long as markets believe that, mortgage rates have a chance to improve. And what we saw yesterday was a strong reaction to the JOLTS data. Brandi, whenever I think of JOLTS, I think of some guy getting electrocuted, right?
Right.
The JOLTS data, JOLTS stands for the Job Openings and Labor Turnover Survey. And basically, it's a survey for the labor market. And this particular survey, like it says up here on the article, this one had job openings tumbling below 10 million new jobs being created, which is amazing to me. Tumbled below 10 million for job openings in February for the first time in nearly 2 years. And normally this is not something that markets have a strong reaction to. We'd get a little bit of a reaction, but not a strong reaction. But yesterday we had a very strong reaction, and it basically shifted that sentiment right in its tracks. The idea, markets were starting to get used to the idea that maybe the Fed would raise rates in May, and maybe they wouldn't be as low by the end of the year. And then this JOLTS data came out, and the market went, nah, they can't raise rates. Never mind. And so what that kind of shows us is that the markets are currently looking for any reason at all to see signs that the Fed can't raise rates. They're looking for confirmation on this. And originally, I was concerned going into Friday's jobs data that the data may show that we have, more jobs being created than expected. Maybe wages are increasing higher than expected, and that could have hurt mortgage rates. But based on what we're seeing yesterday, and again this morning, we had some more data come out, just some economic data. I don't want to jargon everybody, but it was an ISM reading. And basically, it came in a little bit lower than expected, showing the economy slowing a bit. And the markets, again, really took that and ran with it. So markets are looking for any, it's almost like that meme from Dumb and Dumber where he said, so you're saying there is a chance? They're looking for any chance that the Fed is going to go ahead and, pause rates and eventually in the next few months, maybe even start cutting rates. So because of that, our outlook for rates is actually really good. And I'll show my last slide here. We'll go over this and then we can jump back over. So basically, rates currently have a bias to improve, but we'll need help from the jobs data on Friday, other economic reports that are going to continue to come out, and next week's inflation data on April 12th. We're going to get the consumer price index inflation data, consumer inflation. And if it shows that inflation is slowing down, even if it's not as much as markets want to see, if they have their current bias, if they're really looking for any reason to celebrate, we could see a really good reaction to this. But we have to be careful because we could see this change very quickly, like it says here. And we could see sentiment shift quickly. So for those of you that always ask, I think that in the next couple of weeks, we do have a good shot of rates improving. That is very different from what I felt on Monday. Monday, it looked like rates were going to be working their way higher. I was very concerned about Friday's data. Now I'm very optimistic. It looks like markets are very, ready to kind of see a little bit more improvement. And over the next couple of months, it looks like rates could improve a little bit. Now, probably not anything tremendous, but they could improve. In that longer term, we know that rates are very likely to fall once we see signs of a real recession, economic slowdown, labor market weakening, and all that good stuff. So that's my take on things. Brandi, what about yours? What are you seeing in the field? What are you seeing from your consumers and their questions?
Well, I mean, everybody is definitely worried about the rates, but on the other side, we're, obviously having ways that we can help mitigate the rates that they're having to purchase at with buy downs, whether that be temporary or permanent buy downs to get that interest rate a little bit lower. And as long as the payment's affordable on that side, it's, fine.
So for our vetted VA community, if they were talking with a mortgage professional, what kind of questions would they want to ask about mortgage rates or those buy downs that you mentioned? What would be something that they might say to them?
The number one question is that if they're ready to purchase and they understand the rates and they know where they're going in at is, are the rates going to go down in a year or so? And while I want to say, of course, sure, right? I don't have a crystal ball and I can't say that for sure. So I have to say, if you're prepared to make this payment and this payment is comfortable for you, then we're going to hold the payment. And as soon as rates come down, you're going to be one of my first calls. We're going to hop on that and do a streamline refinance and get you down. And use any funds that are left. So a 2-1 buy down is basically the seller giving you a credit to buy down your interest rate a little bit. And it's an amount of money that subsidizes your payment every month. And even if rates come down in a year and that money is still sitting there, that will be a principal reduction. So you're not losing that money. So it's really a benefit.
Yeah, I know some mortgage professionals actually, they call it a gimmick or maybe they don't understand it very well. And again, this is why we're here to try to just give all of our veteran community and the consumers, just some insight in what to ask, because even though these could be very integrity based, honest mortgage professionals, like many other industries, there's opinions that come into play. And I agree with you, Brandi, I think that a 2-1 buy down could be a very good situation. And can you just explain to everybody in a little more detail, when you say the seller gives you this money, and what does 2-1 mean? How does that actually work?
Yeah. So the interest rate in your first year is reduced by 2 full percentage points. And then the following year, so you get 12 payments, 2% less than what you qualified at. The next year is 1% lower. And the third year, you go back to the rate that you were qualified at. So it gives you a little bit of relief in payment for those first 2 years. And ideally, hopefully, we'd like to see that come down. And now, I want to address what you said about the differences between the 2-1 buy down and whether it's gimmicky or the reality is that our industry has to react to what makes it affordable to get consumers in a home, right? And this is just a reaction to, this is what we have to do for now to make it an affordable payment for you, because that's the barrier to entry.
So does it help somebody qualify for a higher mortgage, or how does that work?
No, it doesn't. So you are qualifying at the higher rate. So
Okay.
we need to make sure that you can make that payment at the highest rate. Now your payment will be less for 2 years, but we need to make sure that you are making enough to make that payment in the third year as well.
So it's not like in 2008 where we had the mortgage meltdown. That was caused by qualifying people at the lowest payment. And then when the payment went up, nobody could afford it. So we don't do that anymore. And
Right.
now you mentioned sellers giving money, because otherwise, if I'm paying this money and all it does is help me to lower the rate for the first year and the second year, why would I lay out that money up front? Why wouldn't I keep that money? But you mentioned the seller.
Yeah, so the sellers are offering. So the buy down comes from the seller. You can buy down personally when you lock in an interest rate as a consumer, you're the buyer, you can buy down your interest rate and pay discount points upfront. Anybody can do that. But right now, sellers have a ton of equity and they want to move their houses. So they have enough to where they can give up. It's better and more beneficial for a seller to give up $10,000 in concessions to help you qualify than it is for them to reduce the sales price by $10,000. That the reduction of sales price just gives the seller less. It doesn't help you qualify because that $10,000 does not make a huge impact in your mortgage payment.
Right. And then so what happens is the seller, they make that concession, and that money, it goes into an escrow account, if I remember
It does.
correctly. And that's why
Yeah.
if you refinance, you don't lose it.
Exactly.
How's that different from paying discount points, and why might somebody want to do that versus paying discount points?
Well, I guess it just depends. I guess it's willing on how much if the seller is willing to give up. So if the seller is willing to give up $10,000, which is kind of on average what it takes to do a 2-1 buy down, but there's plenty of other buy down options. There's 3-2-1 buy downs, which I don't think actually works with VA loans just because of our rules and guidelines. But there's a 1-1 buy down, a 1-0 buy down. So there's different ways that we can work this. Or, we can, if they don't have enough equity to give up something to the seller and you just want to buy down, then you can just do a flat buy down. I guess one of the questions that I get most of the time is, what is a discount point? Is it like $1,000 or $3,000? And really it's just tied to a specific interest rate. And it's not exactly, I guess, a regular payment or like $1,000. 5.875 might be a cost of $1,000, and 5.75 might give you back $1,000. So we look at those differently every single day to determine how much it costs to buy down your interest rate, whether you want to do it fixed or whether you want to do a 2-1 buy down with exactly. Perfect.
Right. And then, saying a point, we use the word point a lot. A point is 1% of your loan amount. So if you have a $300,000 loan, a point is $3,000. So $3,000 may bring your interest rate down 0.25%. Maybe you go from 5.75 to 5.5. Now, what you want to do and what you want your mortgage professional to help you with or to do for you is the math. When would you break even on that? So what is the difference in your payment by making that 0.25 point reduction?
Yeah.
And then based on that savings, how long will it take for you to recover that $3,000? And here's why paying points right now may not make sense. If rates, and again, like Brandi, you said before, we don't have a crystal ball, but we know that there are conditions, economic conditions, that based on the Fed raising rates so now to fight inflation, that it is very widely believed that over the next year or 18 months that interest rates will come down. And it's not guaranteed. You want to buy a home today knowing that you can afford the payment. But if they were to come down, you want to make sure that you're in a position to be comfortable to refinance. And we also talked about that EARL, which is the rapid refinance loan that is, something only for VA members,
Correct.
VA entitlement, VA mortgages. So in that scenario, if somebody did pay $3,000, or maybe they paid 1.5 points and they paid, $4,500 and they refinance, do they get that money back?
No. Yeah. No.
So once
when
it's
you're
paid,
once it's paid, you bought down the interest rate for that rate and you were going to refinance in a few years. So it doesn't always make sense. I think the way that I talk to my clients about or anybody who inquires is, we obviously want the recoupment of whatever it costs you to do that to be under, definitely under 5 years. I'd like to see it even less than that, under 3 years for that recoupment. If you're going to be, just depends on how long you're going to be in the house. But under, say, $3,000, we can kind of make that make sense if it makes your payment a little bit more affordable. But going over that and paying that $4,500 yourself, I'd probably advise against it. If the sellers were going to do it, I'd probably say, sure, it's coming from the sellers. But
Right.
personally, out of your own funds, I wouldn't go for that.
But if the seller is willing to give money towards paying down the interest rate, maybe explore what you said before about a 2-1 buy down. That way, that money, number one, will always come off your principal because it's actually held in a separate escrow account, and it's that money is applied towards your loan, and you would see a much larger reduction in payment in going a full 2% down instead of an interest rate at 5.75. You're paying the mortgage at a payment of 3.75, and instead of maybe going down to 5.5. So again, it's only a temporary situation, but it does give you some cash flow relief, which a lot of people could, get a lot of value.
Yeah. The biggest problem right now is payment, right? It's payment. That's what we want to make sure, that your payment fits within your budget.
So one more thing, there's always some talk as we come across this stuff. What do you think is now still a good time to buy a house, and why?
I think the best reason to buy a house right now is because sellers do have equity to give up. That is the biggest reason. So if you are short on funds, if you didn't have money for closing, and I run across this like quite a bit with VA clients or even other loan type, conventional or FHA, I run across this where if you don't have the cash flow, this is the time to purchase the house, because the sellers are willing to give that up to move, because they need to move their property. They need to move on to either something bigger or to a different area. So this is going to help you with that cash problem.
Awesome. Fantastic. And a seller concession, as I have on the screen, that's when the seller basically takes some of the proceeds of their sale and they give it back to you as a consumer towards your closing costs. And there's different rules that surround that. There's certain amounts and limits to how much they can give, what it can be used for. And a mortgage professional like Brandi could help you with that. You could ask questions about that here in the VetaVA community, and your VetaVA moderators will point you in the right direction and explain it to you in detail. So, Brandi, we are at our 20-minute mark. Is there anything you'd like to leave everybody with today?
Well, I mean, I just want to say that we do sympathize on our side that interest rates are high, and our goal is to help make sure that you understand, so you make informed choices when you're locking in interest rates.
Awesome. Yeah, no, absolutely. And it's funny because they are much higher than where we've been the last couple of years. But I remember back in the dinosaur age when I was a mortgage originator and I used to write loans on a napkin at the golf course back in my day when you could do that. But I remember 6% was a great rate. We were refinancing everybody to 6%. And all the arguments of yes, but homes were cheaper and different things, 100% true. But mortgage rates definitely are perspective. And these rates are here to stay. They may improve a little bit over time, but we're not going to see COVID rates again, people. Don't wait for 2 or 3%. Home prices also, that's the other thing that people say, is they think home prices are going to drop. That house isn't worth that much. Well, yes, it is. In this market, it's worth what people will pay for it. We have an inventory issue. People are willing to pay for those things. So keep all that in mind. I will leave everybody with that last forecast. We do have a good shot this week of seeing rates improve. Friday could bring a lot of volatility. We're going to get jobs data on Friday. And jobs data brings volatility anyway. It's a multi-part report. It talks about new jobs that were created. They call them non-farm payrolls. I guess they separate farm jobs from the rest of the jobs. And we look at the non-farm jobs that were created in the economy. They're going to look at the unemployment number. They're going to look at what's called the participation rate, the people out there that are actually looking for jobs. And they're going to look at the wages and how much wages have gone up. Now, this report always comes out on a Friday. But this Friday is a special Friday because it's Good Friday. And on Good Friday, normally the stock market and the bond market are both closed. Now, the stock market is still going to be closed this Friday. However, the bond market is going to be open because of the release of this data. Now, again, it's just a little bit of a weird situation that it is released on I'm going to call it a quasi holiday. And so we're likely to see less traders trading than normal. A lot of them are going to take the weekend off. They're going to leave on Friday early. So that can cause some volatility. Mortgage rates may jump around and be a little bit crazy on Friday. Now, that could be very advantageous. If we get a report that the market's like, we could see some really great mortgage rates on Friday. And if we see something that the markets don't like so much, we could see a very strong negative reaction. So just be aware of that. But overall, I think we're actually, if you'd asked me on Monday, I would have told you don't risk it. But now things have changed. I think we've got a really good shot at seeing some improvement there. So that's what kind of where we're at. And then on Tuesday, before we do the show next week, we're also going to see that inflation data come out, and that'll be another day that we could see mortgage rates really bounce around. So if you're currently under contract, you're not yet locked in, talk with your mortgage professional about those dates. Make sure you're comfortable with them. Otherwise, join us again next week. I will be here on Wednesday. And Brandi, thanks again for joining us.
Thanks for having me.
Take care, everybody. Bye-bye.